Know what you are backtesting, know the system that you're backtesting, and be 100% honest. You are trading as if you were trading that.
Good morning, good afternoon, good evening, traders. We got Pips of Persia coming back for one more video. You see, as you can see, we are talking about backtesting. Now, not just the backtesting you think, but the key 3 stages of backtesting that every trader needs to know if they actually want to become profitable. What you have to remember is ultimately trading is a skill, and the more you do it, the better you're going to get. However, if you're practicing the wrong things, you're going to continue to reinforce bad habits for yourself and ultimately keep yourself stuck in that spiral of failure. But if you want to actually enter the spiral of positivity and success and abundance and growth, where your trading account is consistently profitable, there's key skills you're going to have to master along that journey. Now, the first skill set is always being a proficient analyst. This is where backtesting comes in, so you can continue to get better as an analyst. And what myself and Pips of Persia have done for you is exactly giving you everything you need to know to help you become a better analyst by backtesting. With no further ado, let's get into the first layer of backtesting. You see, I never understood the importance of backtesting. I remember when I was still in the pursuit of profits, I couldn't figure out why I was losing all the time. And when I got my first mentor, he actually broke down to me and analyzed my charts and told me that, Kieran, the concepts you're applying right now are completely wrong. And I was like, wait, what do you mean they're completely wrong? All right, I watched the course, I applied it to live markets, and I just can't win. Like, why is it wrong? What the hell is going on? And he goes, well, you completely applied it all wrong. What you need to go and do is go and backtest this strategy in hindsight so that you can train your reticular activating system. And I was like, wait, what? What's a reticular activating system? And basically all it is your RAS is your selective focus. If you've ever had a car or something you wanted to buy, when you start thinking about it, all of a sudden you see it everywhere. For example, right now, if we start thinking about the color blue, right, we're gonna see all the blue objects and items around us. And it's the exact same thing in trading. So if we want to first be a better analyst so that we can be a better trader, we have to train our selective focus, train our eye to see these patterns in the market. Now, of course, it's not a direct pattern every time, but understand the market behavior. When you see something once, cool, you might remember it. But seeing it 100 times, 1,000 times, 5,000 times, 10,000 times, you're truly going to be a master, because what gets repeated will get remembered. Trading is one of the only industries where people come in, do 10 minutes or an hour or a week of work and expect to be millionaires and then ultimately quit. If you was going to be a surgeon or a doctor, right, you don't just go and operate straight away. There's a methodical process. The problem is in trading, there's no university you can go to that's going to teach you everything. I mean, that is why I created my mentorship, where I've got a complete blueprint that leaves no stone unturned, which of course, if you want to join the mentorship, send me a message on my Instagram. Link is in the description. Again, I can't guarantee if you will be accepted. It all really depends on a case-by-case situation. So send me a message and we'll see exactly what is possible for you and your future trader. But again, you have to continue to train that selective focus. So you might be like, all right, cool, Kieran, I've backtested, I've spent the time on the charts, but what's next? So what you want to start doing now is collecting data. Now, Pips of Persia, he's going to go through a lot of this later on in the video, as he'll be covering the second level, but you have to begin to collect data on these concepts to find out, well, firstly, environments where they do work and environments where they don't work. There may be a perfect entry criteria, but if it's a certain day of the week, or if certain principles are not in alignment, that criteria can be completely blown out of the park and may not work. It may only work in some very, very specific environments. So you need to collect data and see, when is it going to play out? When is it not going to play out? If you're completely new, you may not know how to collect data. I did create a video on exactly how you can begin to journal already on my channel. But what I want you to do first is collect data on each concept of your trading plan. For example, in my trading plan, I've got a list of criteria and steps I need to follow. But I can't just go to the kitchen and expect to have a cake. I have to learn what each ingredient is and exactly when it needs to be applied. So what I do and what I did in my journey is I went back and figured out each part of my trading plan. What is the one concept I have to use at this time? Let me go back test it and collect data so I can train my eye to see individual concepts. And then once you've trained your eye to see those individual concepts again and again, then you can start seeing how to actually put it all together. So for example, if we were to backtest the Wyckoff price cycle, we can see clearly, right, that we've got an accumulation. After our accumulation, we've got a reaccumulation. And again, right now we're not talking about validating. I'm just getting you guys used to backtesting one concept at a time and then starting to put it together. Right, reaccumulation. Okay, up into a distro. Okay, what happens after the distro? All right, we start to redistribute. Okay, we start to redistribute, but then why do we accumulate here and go in a bullish market? Right, this is where you can begin to start getting curious and ask yourself questions about the market. This is why you start to collect data. If you've seen 1,000 times where price accumulates in a prior zone of demand, and then price continues to rally higher and give trade opportunities, you're seeing something for a reason. Your eyes are not deceiving you. So you can begin to note down the conditions in which this occurs. And then what you can do once you've got these conditions where it plays out, and the market actually respects from these areas because you're seeing it again, like trust me, go on the chart, find an accumulation that has led to a new high or low in the market, and see how many times when price comes back to that accumulation and provides a lower time frame accumulation, how many times you get continuations. Right, the reason I'm so confident in my setup and no one can tell me otherwise is because I've seen it play out so many times. Right, you have to train your eye to see your setup again and again and again. It takes over 10,000 hours to master a skill set. So in trading, I say it takes 10,000 charts. But here you are in your first month expecting profits and crying about it because you blew an account. Well, welcome to the real world, son. This is where you got to push forward and now go towards that pain. Now, what you can go ahead and do as well is start to compare price action. So for example, if we know that, okay, this accumulation here ends up giving an entry and a reaction for price to go and give us a nice trade, let me go ahead and take a screenshot of that. But once you've got that screenshot, go ahead, document it, right? Put it into a document, begin to annotate it, write out what commonalities and what things that you notice. Then go find an accumulation which doesn't end up holding. For example, you can look at this accumulation here and ask yourself, well, why did this accumulation not create new highs and end up losing? Or over here, why did this start to accumulate and then redistribute, right? Now you can screenshot this and then begin to compare chart 1 to chart 2. What commonalities, what factors do you notice? What about duration? How long are those schematics taken to create? Right? If you want to get a bit more advanced, you can start to zoom out and start to see, oh, okay, well, where was that accumulation? Was that accumulation in prior demand? And if we zoom out and take a look, right, that accumulation wasn't in demand. Our demand zone is all the way down here. Then price reacts from our demand zone and eventually starts to create another bullish market cycle. But again, how many times have you seen that play out? That's why collecting data is so important. You can begin to validate, well, this is valid demand because of X, Y, and Z reasons. This is invalid demand because of X, Y, and Z reasons. And again, it just takes repetition. And as you begin to start piecing these concepts together, this is where you can start to see more of your trading plan playing out. Because when I just went to the market at the beginning and I was just trying to apply my trading plan straight away, what was actually happening is I was creating negative reinforcement. Now, when I say negative reinforcement, it's like if you have a kid and he, for example, destroys something in your house and paints all over your walls, and you're like to him, oh, that's a good job, that's a really good job. What's he gonna do? He's gonna do it again. What happens sometimes is our trading is we backtest something that we think is our setup, but in reality, it's not. If we take that trade 100 times in the future, what if 99 times it's gonna lose, right? We don't factor in those things. So this is why collecting data is so important to figure out, well, how many times will this actually play out? Based on what conditions. As you begin to start implementing your trading plan, this is where you're going to really start to excel and see things come together. Right, remember, before you start baking the cake, you've got to get all your ingredients together. And that is what phase 1's about. Getting your ingredients together, becoming a good analyst to seeing each concept, understand, okay, this egg's here, this is flour, this is a spatula, whatever. Or for example, if you're flying a rocket, you don't know how it works. Before you can pilot that rocket, you've got to figure out all the intricate parts, what they do and why they're there. Then once you've done that, you can now begin to put it all together. And that's exactly what Mr. Pips of Persia is about to go through now. And I'm so excited for this because if it wasn't for Mehdi, bro, I don't know where my trading would be. So if you've never seen Pips of Persia's teachings, guys, he's got some fire on his channel. Definitely check it out. And let's definitely get him to over 50K subs. Sheesh. So with that being said, Pips, take it away.
First things first, you cannot backtest if you don't know what style of trading you are trying to follow. So first, define if you're a short term, which means a few minutes to a couple of hours trader, or in other words, you're a scalp trader. Or if you want to hold your trades for a few hours across different sessions or even a new day, better known as an intraday trader, or if you want to hold your positions for longer than that throughout a few days or maybe even over the weekend, which will make you a swing trader. This will help you define the time frames you want to backtest. For example, if you're a scalp trader, you probably only need to focus on the minute-based time frames because you want to be in and out of the market within a space of maximum 2, 3, 4 hours. Whereas if you consider yourself an intraday trader, you're probably still looking at these minute time frames frames for your entries, but you most likely will also be looking at hourly, maybe even the 4-hour time frame for slightly higher time frame bias. And if you're a swing trader as well as all of these lower time frames for your entries, you may even need to focus more on 4-hour or even the daily time frame or even the weekly time frame to understand the bigger picture of what position you are trying to get yourself involved in. You always want to start your back testing at a middle time frame relative to your style of trading. What I mean by that is if you're a scalp trader, let's say you decide to only focus between 1 minute and 30-minute time frames. So 1 minute is your relative low time frame, 30 minutes is your relative higher time frame, which means you need to start your back testing somewhere around the 10-minute to the 15-minute mark. If you're an intraday trader and you want to look at these time frames and the hourly time frame, then you probably need to start your back testing somewhere in the middle time frames, so around the 15-minute to the 30-minute time frame. Whereas if you're a swing trader and you want to focus on the hourly 4-hour time frames, then you probably need to start your back testing somewhere between the 30-minute to the hourly time frame. What I'm trying to say is when you start your back testing on a middle time frame relative to the style of trading that you're trying to follow, it will allow you to zoom out to the larger time frames to see the slightly bigger picture of what you're trading, but it will also allow you to zoom into the smaller time frames to refine your entries. Next, you need to define the sessions that you want to trade. This will have to be a realistic reflection of your day-to-day life and the sessions you will be able to actually trade when you finish your backtesting and you want to trade live. Based on this, limit the currency pairs that you want to backtest. For example, if you know you're only going to be able to trade during the European sessions, early morning, for example, London time, then it probably makes sense to have a look at the European currencies. Maybe you want to focus on pound and euro, for example. Whereas if you're trading the New York session, then practically any US dollar or Canadian dollar pair will be good to trade. Maybe you want to trade the equities open because you want to focus on things like gold, things like US 30 or other equities, other assets that relate to equity open or the New York Stock Exchange open. Or maybe you're going to be busy throughout the whole day and you just want to focus on the Asian session. So I guess it makes sense to focus on the JPY pairs or maybe a UD and NZD. Now, this is only my personal opinion to limit the pairs that you are looking at. When you look at successful traders, there is not one set backtesting plan that they are all following because they all probably had different lifestyles before they became a consistent full-time trader. So you might speak with someone else and they might tell you backtest every single pair because this way you are going through more data, you're analyzing more, you're getting your eyes used to seeing more scenarios and giving yourself a higher probability of adapting to market behavior a little bit sooner. There is no right or wrong when it comes to this. This all depends on your lifestyle. This all depends on how you want to approach backtesting, how you want to approach your day-to-day trading later on. So have a genuine think about this. I can't elaborate on this anymore. You just have to sit down and actually plan what you do every single day, what times you want to be backtesting, what times you want to be trading, and think to yourself, does it make sense for you to only look at maybe 2, 3, 4 currency pairs, or do you want to have a look at all of them to start off with and maybe limit it later? The truth is, when you become a successful trader, you're probably not going to be trading every single currency pair. So it makes sense to limit it from the beginning, in my opinion. Once all of that is done, start having a clearer definition of what your general confirmations or trading plan should consist of. Things you should include in your checklist, in my opinion, will be things like order flow or market structure, or anything else you use for direction analysis, followed by objectives. Now, these objectives include, but are not limited to, things like liquidity creation or liquidity manipulation, or mitigations of different levels, such as institutional candles or Wyckoff schematics or imbalances, or where you consider the price to be at a discounted level or at a premium level. Some people will use Fibonacci to find out their discounted and premium levels, but you can often tell based on the type of pullback that you have had after an impulsive move that had an objective, after an impulsive move that came from some type of a Wyckoff schematic. Try and write down a list of confirmation or analysis techniques that you have learned to know exactly what to backtest. Remember, behaviors can look different on different time frames. So for example, on a higher time frame, you might see that the market is coming down and down and down and down because it may be mitigating a certain level down here. It may be coming down to fill an imbalance or maybe mitigate an institutional candle. But that same behavior on the lower time frames can maybe look like some type of a liquidity manipulation to the downside before it comes into this level. Or maybe it could even be considered some type of a Wyckoff redistribution before the price comes lower. So these objectives can look different on different time frames, but long story short, they are all pointing towards the same fact, towards the same story. Your job is to create that storyline and make sense of the market behavior. Spend the most amount of time preparing for this level, as this will help you to be consistent with what you are backtesting and also helps you to avoid confusion. You cannot possibly backtest if you don't know what you are backtesting. And again, trader to trader, this is going to be different. Some of you might even be using certain strategies or indicators that we have never even spoken about on this channel. In fact, when I compare myself to Kieran or myself to other traders who are trading similar styles to myself, we have different confirmations. We look at the market slightly differently because we are different types of traders. Sometimes we go for shorter term trades, sometimes for longer term trades. So again, this is unique to you. This is where you have to spend the time to write these down and decide on exactly what you want to be backtesting. Now you are ready. Choose the currency pair and the time frame that you want to focus on. Go back in time and choose an area in price that you want to backtest and begin. Try and avoid having a look at the future behavior relative to the area that you're backtesting, as if you know kind of where the market is headed, this will give you a subconscious bias. And quite literally, this makes the entire point of backtesting kaput. So there's not even going to be any need for you to backtest if you already know where the market is going to go. The whole point of second stage of backtesting is testing your knowledge and trying to create that storyline without knowing what's going to happen later. Now again, this is a specific point that some traders might disagree with. For myself, I enjoy using the replay mode even because you can put it back in time and you can tell yourself, okay, I don't have any idea what the price is going to do later on, so maybe I can just have a look at what I see here and maybe I can start backtesting. Hey, this kind of looks like a distribution. I wonder what the price later on did when it reached that level. And you end up starting to analyze the price as if it's live, as if you're seeing it there and then. Some other traders dislike using the replay mode, and that's absolutely fine. So again, this aspect of it is unique as well. You don't necessarily have to use the replay mode. It's whether you feel more comfortable using the replay mode or just going back in time and trying to analyze the price and little by little seeing where the price is headed and changing your analysis or completing your bias based on the new information that you come across. So I don't want people thinking replay mode is a necessity, because it's not. My entire point was there's no need to backtest if you already know the price definitely came to mitigate over there, because you will tell yourself, hey, I know the price came here, so instantly you'll start to look at sell positions at this area. Whereas if you didn't know the price is going to come up to, for example, mitigate this level, maybe, just maybe, somewhere over here you would be looking at buy positions, or maybe you would consider this an accumulation and wanting to get yourself in a buy position and would have ended up having your take profits over there. So you have to be realistic in this sense. Now, using your set of rules, analyze price, decide on the direction that you want to trade in, and mark rough entry areas or levels that you want to pay attention to price behavior once the price gets there. So you may even tell yourself in this case, hey, this is a distribution, or it looks like a distribution. I wonder what the price did later on when it reached this level. So you end up highlighting this. Or at the same time, you might look at this behavior, considering this some type of a bearish structure. So instantly you would be looking at sell positions, for example, and you would have rough areas marked up for your sell positions, or at least areas that you're not sure whether or not you should enter based on. So you kind of just want to mark it up to see how the price reacted to that level on the lower time frames once it ended up reaching that area. You have to backtest with this mindset. You have to give yourself scenarios to play with. So always give yourself if-then scenarios. If this happens, then I will do this. If the price mitigates, then I will do this. If the price approaches this level, then I will, for example, go on the lower time frame. If this is my rough entry level, let's say, but the market ends up doing something else, then I'm going to react to it this way. So always give yourself if-then scenarios. Once you do this, it stops you from being married to your directional bias and being so sold on an idea that the market might go down or it might go up that it will make your entire backtesting pointless. It will allow you to, instead of trying to force your bias onto the market, be a little bit more adaptable and give yourself scenarios that you can work with. If something happens, then this is how you will react. This will also allow you to rebuild your narrative if need be, which later on will help you to stop taking trades that do not match your set of rules. Once you have defined your direction and entries, give yourself scenarios of what will invalidate your bias and entries. This is now a stage that a lot of traders don't follow. They don't give themselves scenarios of what will invalidate that entry. Example, you might be looking at certain buy positions at this level because that kind of looks like an accumulation, and maybe, just maybe, you go ahead and consider this a break of structure to the upside. So now you're looking at maybe some areas down here for buy positions once the market reaches this level. You need to also give yourself scenarios of what will invalidate that entry. Okay, so if we approach this level and on the lower time frame, the price kind of looks like it's redistributing, I'm going to be careful because if it dips below, it's going to invalidate my entry. This is very, very, very important. You have to know what scenarios will invalidate your entries and invalidate your bias, because this will allow you to build a second narrative before you see what the price ended up doing. So you will be able to rebuild your narrative by the time you see something like this and try and see if you can catch the trade elsewhere without necessarily knowing that, yes, the market did end up coming all the way down here. I hope I'm making sense. This is very important to be realistic when you're trading, because that's how you're going to be thinking when you're actually trading the live charts. Also remember that when you're defining your entries, you also need to be very clear about where your stop losses and take profits are. And don't just extend your take profits thinking to yourself, hey, if I went ahead and sold it at this level, I would have gotten in, for example, with maybe a 5 pip stop loss or whatever. Well, I can't even put it at 5 pips, let's say 16 pips. And oh my God, look, the market came all the way down here. So I actually would have ended up catching a 1 to 67 there. That's the wrong style of backtesting. You don't want to do that. You want to be realistic with your stop loss and take profits before the trade plays out. So you might tell yourself, okay, yeah, I would have entered at this level, but realistically speaking, I would have ended up taking my profits at this low. So I would have only been able to catch a 1 to 16, for example, which is still amazing. But doing this is teaching you to now be realistic with your stop losses and take profits as well. Define them before you figure out where the market is headed. Now, the next few points is something that I have barely seen any trader speak about, which means a lot of you are not already using in your backtesting as well. So pay very close attention, because this will revolutionize the way that you end up trading. You have to pay very close attention to the exact days and the exact times that you are backtesting. Are these the normal hours you will be trading? Did the market come to your entry at a time that you would have been free and awake to trade it? What happens a lot of the times is when people are backtesting, they go on a lower time frame and they go back in time, and instead of paying attention to all of the factors that we mentioned, they will end up just, randomly, for example, highlighting. I'm just gonna do a random thing. Let's say randomly highlighting an entry at this level over here. Let's go ahead and highlight that rally-based rally. So maybe they would have highlighted an entry around this level. And they would have been like, oh my God, yes, I was right. The market came into this level. Amazing. It even manipulated liquidity to the downside before it came in this level. So yay, this would have been a winning trade. But they might not pay attention to the exact day and time that he ended up coming into this level. That's now Wednesday at around 12:15 UK time. Maybe at that time on a Wednesday, they would be at work without any access to their phone or their laptop. So realistically speaking, they wouldn't have actually ended up taking that trade. Or maybe the market would come to your entry, for example, during Asian session where you'll be sleeping. Paying attention to the days and times that you will actually be trading will stop you from considering certain winning scenarios as a winning scenario, when in reality you wouldn't have even taken that trade in the first place. So again, just be honest with yourself when it comes to it. When you highlight your entry, pay attention to when it came to this entry. Pay attention to when, for example, that entry was highlighted even. What time was it created? Would this have been a normal day and time that you would have been trading? If so, then consider it a winning trade. Obviously, it goes without saying that this point is reconnecting back to one of our original points on this section, which is defining the sessions that you will be trading. So once you have that defined, you're naturally also checking the exact times the market comes to play, because you're only backtesting certain sessions. Now, you also have to remind yourself what you're actually backtesting. What's the point of you backtesting? Are you trying to get better at trading, or are you trying to see if your trading style is working or trading confirmations are working? Know what you are backtesting. Know the system that you're backtesting, and be 100% honest. You are trading as if you were trading that market live. That's the best part of backtesting. You continuously have to be thinking about your thought processes, and you have to also remind yourself that when you're backtesting, there's no emotions involved. But when you're actually trading on the live charts, it will be a whole different scenario. This is why it's important to do two things. Number one, to document. You have to document the scenarios that you're backtesting. There are so many different ways that you can document your trading, from sending yourself screenshots on Telegram to actually using, for example, an Excel file that you can document your trades in. I'm sure Kieran has a video on documentation. We'll be releasing a video on documentation soon, so you can go into a lot of information about that in another video. But you can also just document on a pen and paper. You can have a pen and paper next to you, and before you analyze, or as you're analyzing a scenario, you can quickly write down the confirmations that you have had, then also write down the time the market came to your entry, whether or not it was a successful entry, and then take a picture of it and save it somewhere. Documentation is key. There's only one thing that I have seen common between all of the successful traders that I personally have spoken with, and that's how they document. Every single one of them is so organized and so good at documenting. It's a skill that they have learned, and it has directly affected their trading success. And the second thing to do is to pay attention to duration. How long did the market take for it to come to your entry? Let's look at this example. From when that entry was highlighted to when the market came into that entry, there was a 2-day and 6-hour gap. So that is what, nearly 54 hours or so, or more even. So you have to start asking yourself questions like, what would you have done in that time period if you were trading this live? You have to ask yourself these questions when you're backtesting. What would you have done within 2 days? Maybe you would have ended up taking other trades. Maybe you would have actually looked at this as another accumulation and would have ended up having an entry over here, which would have resulted in a loss. Maybe you're trading slightly different systems and you would have considered this a zone of support and would have ended up taking your entries over here and would have taken one loss before the market came to your entry. Or maybe because you considered this a distribution and then considered this a break of structure to the downside, and maybe this some type of perhaps a mitigation of distribution. Obviously, I would just consider this equal highs over there. Then you wouldn't have even been looking at that buy position anymore. Maybe you would have tried to enter yourself in a sell position somewhere over there, for example. So be honest with yourself and ask yourself, what would you have done in that time? Would you still have looked at the same entry? Would you have taken more trades in between? If so, how many losses would you have experienced before your entry? Be realistic, and for the 100th time in my section, be honest with yourself. Be honest with how you're backtesting. Paying attention to the duration it would have taken you to enter that trade is going to be one of the most important factors. And again, a factor that I haven't seen a lot of traders focus on. It will literally change your entire backtesting. So once you have your areas highlighted, don't just instantly jump to see where the market would have gone, whether or not it would have reacted to that level. Try and follow the price step by step to then see how the market ended up coming into your level, if it ended up doing something else before it came into your level, and if you would have reacted differently provided you saw that same scenario live. So just to very quickly and briefly summarize, first you need to define the trading style that you're following, whether you're a scalp trader, intraday trader, or a swing trader. Then you need to define the sessions and the currency pairs that you want to actually focus on. These would be a direct reflection of your day-to-day life and exactly the times that you will be able to trade when you decide to go live. Then write a list of the confirmations or the analysis techniques that you want to use and you want to backtest. Always start on the middle time frame and avoid having a look at future behavior to give yourself a subconscious bias. Don't forget to give yourself if-then scenarios. If this happens, then I'll do that. If that happens, then I'll do this. Define your entry, stop loss, and take profit. Remember to always have a look at the day and the time that you will be backtesting. And last but not least, and perhaps most importantly, pay very close attention to the duration of the trades or how many losses you would have been taking before your main entry. But with that being said, I'll go ahead and pass it back to Kieran so he can share with you the third and the most important stage of backtesting.
Sheesh, man, I love when that guy teaches it. He's got some sauce. Now, you've got to that point where you're seeing your trading plan play out. You're understanding, okay, this keeps happening on specific days of the week, certain times of the day. You're seeing it come together. Now what you can do is begin to start forward testing. Now, forward testing is essentially starting to trade and see the market in the future. So you've done everything from the past before. You're getting your eyes used to the market. You're seeing it play out again and again. Great, fantastic, amazing. Now it's time to see how you apply that in real time. So now, before you start actually trading and getting on your live account, right, relax. What you need to do first is warm yourself up. Now, just like if you were in the gym, you don't just jump into 200K bench press. You got to warm yourself up. You got to stretch your muscles. Same thing in the market. Right, before I start trading, what I'll do is spend some time to warm myself up. And I'll do that by doing an end of day or end of week markup. It's very simple. So for example, let's say we go to a fresh chart. Now, predominantly, this will be more for like lower time frame traders and obviously day traders, which I assume the majority of you are. Now, of course, if you swing trade, I will go over exactly how I swing trade backtest myself and how I use that to backtest because it's going to naturally flow, right? I do the end of day backtest to see what happened yesterday. And at the end of the week, I do the end of week backtest to see what happened over the course of the week. Sometimes the market, yes, there's daily cycles, but there's also weekly, monthly, and yearly cycles. If it's fractals, it even goes up to like decade cycles and above. In the habit of doing these end of day markups, because even if you miss a trade or even have a losing day, the reason you may have a losing day or be losing all the time may always not be due to your technical analysis ability. Sometimes it's our psychology that influences our perception, so we see things that are not there and force different setups. However, that's a combo for another day and maybe a little bit later on the video. But end of day markups are very simple. All you're doing is literally just checking the last 24 hours of price to see what moves was there and was there a setup that met my trading plan. Now, this is the key, right? And this is the difference between an amateur and a professional. An amateur is going to go to the market, look at yesterday's price action and say, oh my God, right? I've seen, for example, a breaker structure here, all right, and price could have given me an entry and I'm going to just ride it up and close it exactly, and just close it up exactly where price, stops and would have closed there. But this is the thing, you can't replicate this. You have to have that trading plan with distinct entry and exit criterias based on the market environment you're trading. So for me, automatically by looking at this, I know this doesn't even meet my trading plan. Why? Because this is an accumulation that I can't even validate and see true intention that buyers are in here. Yes, for example, this one singular buy may work out on that one day, but because I haven't collected data on that setup, I don't know if that will work for the next 20 trades or the next 50 trades. And again, it goes back to what I said at the start with the negative reinforcement. So for me, right, that's the key. I can't validate that, so I'm not going to trade it. Now, this is where you can now look at another currency, or you can look back at the day before that and do an end of week markup if it is the weekend. So for example, what I'll do is just zoom out a little bit. There's a handy indicator I found called weekends, and it just puts like a yellow line on a weekend. And now we can kind of focus on this piece of price action from the yellow bar to the right, because this is from Monday, obviously Tuesday, Wednesday, Thursday, Friday. So then what I'll do, all right, is go begin to actually look and see what's going on. Maybe zoom out a little bit more, see what happened. Oh, okay, right, price began to break some order flow. Okay, all right, price then began to actually mitigate out of some demand in our news manipulation that occurred over here. Okay, what happened from there? Price then began to show signs of accumulation. Okay, right, we had a little minor break of order flow in here. Okay, so let's zoom in and investigate what happens. Okay, right, price does then come and give another mitigation. Okay, so all we're doing is just zooming in and going down the time frame and right. Like Pip said, you always want to start on a time frame above the one you're looking to actually trade. Now, of course, like myself, I personally always do top-down analysis and start from the highest time frame when I'm analyzing completely fresh. But of course, we're looking at back test here and data that has already played out. Okay, from there, well, let's see what happens. Price then comes and mitigates off this 50%. Well, what does it do on the lower time frame in here? Now, again, the key is can we validate it and discern, is this a setup we would have taken? All right, let's see if there's any Asian manipulations. Okay, there is. Okay, price comes and accumulates down here. Now, is this a valid accumulation? Right, can we validate it? For me and my trading plan, I can. Okay, what happens next? Where does price trade into? And again, it's just building commonalities, right? Even if you don't have my trading plan, by putting in the work, you can see it again. Now, of course, if you do want to streamline that process, again, you can always join my mentorship. But for the meantime, we can see price then comes to mitigate what? The 50 of this last manipulation. Okay, building commonalities. And again, we can see price then builds another valid accumulation outside of it and gives a beautiful entry, right, off the 80%. But of course, this is where your trading plan comes in to tell you what to do. It'll be a lot harder if you don't have a trading plan, of course, but this is why, for me, right, I'm such a big advocate in investing into education. For me, I didn't want to spend all this time figuring out a trading plan myself from scratch, right? I just actually paid to learn of someone. So what we can also do is start to see, okay, well, in terms of loss and profit, what would have happened? Would there have been any other trades that I may have lost out on? You can start to factor in, okay, well, what if, right, I was looking to trade off this reaccumulation here, had an entry off this. Okay, if we're trading a 100K account, how much risk would we have assigned at that? Okay, let's say on a 100K account, we would have thrown $125. Okay, right, how would we have managed that? Does our trading plan allow us to actually reduce our risk? For me, it would have. Once price began to break this minor order flow and validate a lower time frame accumulation, right, I would have reduced my risk below this stop loss. So instead of a $125 loss, it may have only been a $100 loss. But let's still begin to factor that in. Then we say, okay, well, what if price then come down to our 80% down here? Okay, so we lost that 125, but then where would we have partialed out from? At these highs, we would have partialed out. So how much profit would be floating? Trusty calculator, 125 times, what was our risk reward? 12.53. Okay, we would be up $1,500, 1.5%, risking 0.125%, right? 12x on our investment, great. Now, how at that floating profit, right, how much volume would we have closed? You know, and this is the things you can begin to simulate and do. Would you have held for higher time frame targets? In this case, you have higher time frame points of interest, so you could have, right? You could have been holding to these highs. But what if it was a lower time frame day trade? What situation are you in? And this is where you begin to become a better trader and a better analyst because of repetition, and you have that time in the game and the experience, right? Why do you think high level athletes are at the highest level and get paid the most? Because they dedicate and are obsessed with it. Now, if you want this to pay you like a business, you got to treat it like a business. Because if you treat it like a hobby, well, listen, I don't know any hobbies that pay well. And I will methodically do this sort of stuff every day and every week, warm myself up before I analyze the market. Because if I can invalidate certain things and see, okay, well, again, why did this accumulation over here potentially fail? Or why did this accumulation fail? And I can begin to compare it and collect data on it. This will help me get better as a trader in the future. Now, the next level is actually getting someone to validate your backtest and validate the chart work you're doing. You see, for me, if I didn't have a mentor and someone to actually show my work I was doing, I don't know how I would have got any better. How can you teach yourself something that you're not successful at? That was a realization I had to come to. Then I had to drop my ego and then reach out. I didn't want to reach out and ask for help of people, but I had to swallow my tongue, swallow my pride, and take that leap of faith. By doing these end of day markups, end of week markups, you're going to see and collect this data. So what you can begin to do is compile it in a spreadsheet. If you haven't downloaded my journal yet, I've done a whole video on my journal on how you can actually begin to document these trades. And then from there, it's just about collecting data and thinking in terms of sample sizes. Don't just think in one trade. Again, I've seen so many traders who win one trade or lose one trade and automatically think that this trading plan doesn't work or this is the best trading plan in the world. What you have to do is collect data. Just because a trading plan works out for one trade doesn't mean you've had any skill. We can literally go to the mall right now, ask a random stranger, heads or tails, flip a coin, guess buy or sell, drop 100 lots in EU and it shoots up 1,000 pips and we make bank. But does that take any skill? No, there's luck, right? How you avoid luck and make sure you're gonna get a consistent outcome is by making sure you have that consistent return and think in terms of sample sizes and probabilities. Just like if we were to flip a coin. If we flipped a coin 10 times and every single flip landed on heads, come on, we're not gonna say that that coin is head-sided. We're gonna increase the data, increase the sample size, and eventually the numbers will begin to play out if we had a consistent approach. Now, if you adjust the height and which you flip the coin from, of course, the results will be very random. However, if you have the exact same height, the exact same force flipping that coin, the exact same approach, eventually when the sample size shows, you'll get that 50-50 split. So when you trade, how does that relate? Because you need a consistent approach, making sure you've got that trading plan with your validation criteria, your invalidation criteria, everything is distinct and bring it down to a science. Leave no room for guesswork. Like for me, an accumulation cannot be validated because it looks like an accumulation. I need very distinct criteria, and to understand the economic cycle where we're at is to see if it makes sense. Now again, that may sound a bit confusing. Of course it will, because you don't know my trading plan just yet. And if you want to know more about it, of course you can see all my other videos on the channel. But by doing this and collecting this data, this is where you're going to, again, understand your system more. And as you begin to journal and forward test, you'll see how your trading translate. Because when you start to actually trade live, if you start losing a bunch now, well, turns out it may not be your analytical ability. Because you validated it, you've collected enough data, you've had a mentor to validate it for you. It may be another factor. It may be a lack of fundamental analysis. It may be lack of psychological and emotional intelligence, because our emotions cloud our judgment, and based on our belief system can literally cause our brain to represent and show us different data to what we're seeing. What do I mean? Well, let me ask you, have you ever taken a trade, obviously, hit stop loss, and you look back at it like, what was I thinking, bro? Why did I even take that trade? This is not a valid setup. That's because your ability wasn't technical analysis, right? You need to work more on your psychology. You don't trade the markets, you trade your belief system about the markets. I've done tons of videos about this on the channel. Of course, if you want to check it out, just go to my channel and check it. But with that being said, guys, that is going to conclude today's video. Massive shout out to Pips of Persia. I appreciate you, bro, for coming on this video and dropping those gems. Now, of course, guys, let me know in the comments one thing you liked, one thing you learned in today's video. And of course, if you do have any requests or videos you want to see, just drop them in the comment box and let me know. Also, don't forget to follow me on my Instagram because I'm starting to post a lot more trading related content from mindset, from chart work, everything you need. If you guys want to see more content from myself and Pips of Persia, definitely spam the comments. Yo, tag us on Instagram on your stories, let us know. And if the people want it, we will provide. So with that being said, guys, thank you all. And I'm gonna see you all at the top, from the top, because you already know, man, that bottom is way too crowded. Sheesh.